Welcome to The Explainer. Today, we're basically stepping right into the shoes of a fundamental investment analyst. We're pitching a deep dive to an investment committee. And our target? PennyMac Financial Services, ticker symbol PFSI. Now, this is a seriously fascinating setup. The stock just dropped a massive 37%, and it's created this wild divide between what the quantitative numbers are screaming at us and the qualitative story that's unfolding in the news. Let's get into it. All right, here's our agenda for today. First, we'll hit the PennyMac investment thesis. Then, we'll run a quant valuation using 5 different models. After that, we'll put it through Warren Buffett's investment checklist, followed by Peter Lynch's checklist, and finally, we'll wrap it up with our summary and final verdict. So, Section 1, the PennyMac investment thesis. Let's set the stage. Here is the absolute central question we've got to answer today. Is PFSI a screaming value buy, or are we looking at a highly dangerous value trap? See, on paper, this stock is flashing bright green across a bunch of traditional value metrics. But look, you don't just lose over a third of your market cap overnight without a major catalyst, right? We have to figure out if the market just completely overreacted, maybe handing us a generational buying opportunity, or if the stock is cheap for a very good, very dangerous reason. Let's start with exactly who they are. PennyMac Financial Services is a massive, top-tier U.S. residential mortgage lender and servicer. I mean, they manage a colossal $720 billion servicing portfolio. Think about that scale. And operationally, they are executing. They just reported a really strong Q1 adjusted earnings per share of $2.19. So under the hood, the engine is absolutely purring. But what's truly interesting here, what makes this such a puzzle, is the sheer dichotomy. The operational numbers and their tech deployments, like their brand new Vesta origination system, look incredibly robust. But then the stock plunges 37%. So why? Well, it was triggered by escalating securities law investigations and class action preparations. The core issue here revolves around allegedly misleading disclosures regarding their mortgage refinance recapture rates. Basically, regulators and investors are looking at this and questioning if the company accurately communicated how well it actually retains customers when they refinance. Moving right along to Section 2, Quant Valuation, 5 models. Let's see what the math says. All right, so here we're applying 5 distinct valuation models, pulling assumptions straight from their most recent financials. First up, the price-to-earnings, or PE ratio. With trailing 12-month earnings at $9.41 a share, the trailing PE sits at an incredibly low 8.92. That immediately signals undervaluation. Second, price-to-book. The book value is $83.31 per share, which means it trades at a PB of roughly 1.01, so it's fairly valued, basically trading right at its liquidation value. Third, we run Benjamin Graham's intrinsic value formula. Taking that $9.41 EPS and the $83.31 book value, the Graham number spits out a massive $132.81 per share intrinsic value. Fourth, if we look at fair value cash flow proxies and consensus analyst targets, we land at $116.29, suggesting some pretty strong upside. And finally, Model 5, the dividend discount model perspective. They pay out a $1.20 annual dividend. That's a 1.43% yield, backed by an ultra-low 12.7% payout ratio. Honestly, that dividend is immensely safe and has plenty of room to grow. And this gap brilliantly illustrates the massive divide between the current market reality and the fundamental math. You can see the current price hovering way down there in the low 80s, while both the analyst targets and that conservative Graham number sits significantly higher. Mathematically speaking, there is a gigantic margin of safety here. Just to really underscore this point, an 8.92 trailing PE for a company actively growing its direct lending channels and deploying cost-saving AI and tech, that is incredibly cheap. I mean, if this were purely about the numbers, this would be a table-pounding buy, no doubt about it. Now let's pivot to Section 3, Warren Buffett's investment checklist. As we know, Buffett looks for very specific traits. Looking at the positives, PennyMac actually passes a few of his strict rules. Is it an understandable business? Yeah, absolutely. They originate and service mortgages. Do they have a high return on equity? Yes, they boast a 12.32% ROE, which is really solid. Are they shareholder-oriented? You bet. They just recently repurchased 560,000 shares for $50 million. But look over at the fail column. They totally fail on predictable earnings, mostly because the mortgage industry is just so highly cyclical and tied to interest rates. And more importantly, they completely fail Buffett's strict requirement for low debt. Furthermore, Buffett always demands a margin of safety. And remember, that isn't just about the stock price. It's about trusting the management and their protective moat. As Simply Wall Street points out here, the recent investigations are material because they go directly to investor trust in reported metrics. So the crucial takeaway here is that an ongoing securities fraud investigation entirely shatters that qualitative margin of safety Buffett requires. I mean, a cheap stock is completely meaningless if the actual data reporting is in question. All right, on to Section 4, Peter Lynch's investment checklist. Let's see how it fares under his rules. First things first, Lynch requires us to categorize the stock. PennyMac falls squarely into the cyclical category, being heavily dependent on macro interest rate environments. But because of its massive mortgage servicing rights portfolio, you can also view it as an asset play. Understanding this classification is absolutely key because it tells us we can't just blindly rely on linear growth projections. Running through the rest of Lynch's checklist, PennyMac actually scores quite well right out of the gate. Lynch loved boring businesses that Wall Street ignored, right? Well, mortgage servicing is definitely boring. He loved companies buying back their own stock, which, as we saw, they are doing. Plus, an everyday layperson can easily understand how a mortgage works, and their current earnings easily support that low PE multiple. But, just like with Buffett, we hit an absolute brick wall when we look at the balance sheet. And here is why that balance sheet is such a major red flag. Lynch vastly preferred companies with low or zero debt, ideally looking for a debt-to-equity ratio of 0.5 or less. Look at these numbers straight from the source data. $25.88 billion in total debt against just $4.33 billion in equity. That gives us a debt-to-equity ratio of 5.98. Now sure, heavy leverage is pretty typical for financial institutions and mortgage lenders, but for a strict Peter Lynch evaluation, this level of debt is an automatic hard fail. Which brings us to Section 5, Summary and Final Verdict. Let's bring it all together. So let's summarize this immense tension at the heart of the stock. On one hand, the quantitative models, the PE, the Graham number, the cash flow targets, they are all screaming bullish. The stock is mathematically trading at a severe discount. However, when we actually run it through those battle-tested qualitative frameworks of Buffett and Lynch, both of them flash bright red warning signs. They both completely reject the company based on extreme debt levels. Plus, those ongoing fraud investigations absolutely destroy the trust you desperately need to confidently invest in a highly leveraged financial institution. Therefore, our final investment verdict for the committee is bearish to neutral. Yes, the stock is a statistical bargain, but we just cannot recommend it. The qualitative red flags, specifically the immense data gaps regarding just how deep these legal probes into their disclosure practices will actually go, those completely override the cheap valuation. Think about it. When a company's core asset is trust in its servicing and recapture metrics, an investigation into those very metrics makes the fundamental data totally unreliable. Honestly, it's the textbook definition of a value trap. And that leaves us with this final, crucial thought to ponder. We've shown you the immense discount today, but we've also shown you the towering debt and this really dark shadow of litigation hanging over them. In a sector as wildly sensitive as mortgages, are you really willing to catch a falling knife just because the math looks good today? Thanks so much for joining us for this explainer, and remember to always keep questioning the numbers. See you next time.